Good.
All right.
Okay. So, what we really, I think what most people really want to do is they kind of want to know a lot about their property when we're first looking at it in terms of whether or not it's going to make money or not, right?
Hmm.
And that's what we're doing really now. And when I say make money, I don't mean make money in the aspect of the future value, the stuff that we did before where we were modeling, future cash flows and what the ROI is. They actually don't, a lot of people who haven't studied business and business formulas and things like that, they don't really understand actually the future values, right? But what
Hmm.
they understand is the cash flow, you see.
Yeah.
So, and because it's actually not difficult, even though there are calculations that we're going to use that are much more sophisticated than just simple cash flows, right?
Yeah.
Now, now the way I like to do it is to start off with pretending to purchase a property, and I'm going to model it off of one of our purchases we did a long time ago, right? For
Okay.
about 5, 6 years ago, right?
Hmm.
So in this cell you're in here, just type PP for the purchase price. Right? And we paid $900,000 for this property.
Dollars.
And you could just remove the yeah, just to keep it a little cleaner.
Hmm.
So we put a down payment of 20%. So let's do DP there, yeah, and a percentage for the DP down. All right, no, not this way, but just put 20% first because
Oh,
we might want to
I
change it
see.
later on.
Okay. 20%. Oh, there we go. Okay.
And put a percentage right after DP. Now, now we need the down payment dollar amount, so DP dollar. Let's do the calculation there. So roughly, we put down 180,000.
Yeah.
That means we would have needed a mortgage. So let's type in mortgage, and that's just 900 minus the 180,000.
Mhm.
So we took a mortgage for $720,000 in this property.
Yeah.
Okay. Now, now there are a couple things that we have to take into account. When you buy a property, you're actually going to pay some sort of purchase, some sort of uh, what we call closing costs for the buyer. So
Hmm.
we want to say here buyer CC percentage. Okay. Now, the reason why we put a percentage here is because it's just a quick calculation, right?
Yeah.
And we know generally for New York where we bought it, it's going to be approximately 4%, let's say.
Percent.
Right?
Okay.
Now we can put the buyer dollar amounts. Okay? So you could imagine the minute we purchase the property, we are already losing $36,000.
Hmm.
So you take that into consideration. Now, once we have this amount, then we also will add here, right? We're going to add up the down payment and the buyer closing cost, and we call this the investment. This is actually the investment. Okay. Now, and this is where I was getting um, into some philosophy, about how to buy properties and stuff like that. The reality is, if you can't afford the $216,000, right, you need
Hmm.
partners.
Yeah.
Yeah. So below that, below the investment, we want number of partners. Right? And let's just say two at the moment. We could always increase that.
Yeah.
Now, so then we want the dollar amount per partner. Okay. So just like I tell everyone, your problem is not buying a property. Your problem is network. Because if you network with enough people, you will be able to buy any property. It doesn't really matter. Because
Hmm.
even if you can't afford that 108,000, add instead of two partners, put four partners on it. So change that to four, and it's 54,000 and so on and so on. Okay. Now, that just tells us the dollar amount per partner. But I will tell you that every calculation is done on the entire property, right? Because it doesn't matter. You have to think of it this way. Let's go to the right side for a moment, right? Um, Maybe one more.
Yeah.
Suppose if you invested um, $100,000 into a property. So let's put 100,000, right?
Hmm.
And that property, in the end, you sold it for 200,000. So let's put the 200,000 right under it. Okay. So the question is, what is the overall ROI here? Well, we know it's 100%, right? Because you just
Hmm.
doubled your money,
Yeah.
right? But suppose if after doubling your money, and if you had laid out 100,000, you got 200,000 back, so you made 100%. Well, suppose if instead of doing that, you had two partners, right? So
Hmm.
put number of partners. Okay. Now, if this is the scenario,
Hmm.
what is the ROI for both partners? If one will make 100%, if you split it in half for two
Yeah.
partners, what will both partners make?
Both are still making 100% on their investment. It's just half the
Exactly.
amount. Yeah.
Yes. So then the calculation goes like this. And go to the right of the 100,000, right? So each partner will invest 50,000, and then they will sell the investment for 100,000. And it doesn't really matter. They both make 100%,
Hmm.
right, on the return. But most people don't understand this rule, right? It doesn't matter if you do the calculation for the whole property, five partners, 1,000 partners. Even the stock market works like this, right?
Yeah.
That's why you could have millions and even billions of shares, and everyone gets the same return, right?
Hmm.
But somehow people think that adding the number of partners somehow lowers the ROI, but it does not, you see.
Hmm.
So just wanted to point that out, especially here in the video, that it's not about the number of partners or anything like that. Because if you're buying a stock in the stock market, you might be one of a billion shares that you just bought, with a million partners. Everyone still gets the same return. It doesn't matter because it's just this particular rule. You do the calculation on the whole property, and every partner makes the same,
Yeah.
right? Now you can delete all of that. Okay. So once we know that, then the only problem you have is if you don't have the money, is do you have the partners? You see, that's why it was very important, to network because not everyone's going to have the 216,000 to buy the property themselves, right? So now you need partners if you don't have that. And if you had 54,000, you need four equal partners,
Yeah.
right? So that's one of the understanding of when you're starting to create these spreadsheets. Okay, so first we have this, right? Now, the next thing I want is go to the right side in the D column, right? We want to do the calculation for the mortgage, right? So here we want to say mortgage, right? And put the mortgage start date. We'll do it like we did the other mortgage spreadsheet, right? And under that, you want to put month. And to the right of that, let's just start it in March. So that's 3. Day will be the first, and the year will be 2026. So brand new investment, just starting it there, right?
Hmm.
But we need more information. Now we need the principal, right? Let's add that. And we know our principal. That's a 720,000. Let's uh instead of typing it out, let's just use the pointer and say equals and point it at 720. So we have the 720, but now we want to get more information because we're going to have to pretend that we're going to purchase it in March, and what is the most likely scenario in this case for the interest rate? So let's put in rate. Now it looks like for this kind of loan in New York City, if everything qualifies at the highest, meaning you have the best credit scores or whatever you're doing, you are more likely to get it now at around 6.25%.
Yeah.
Okay. And then we want to know how long are we going to be taking this mortgage out for? It's going to be a 30 year, but we're going to put it in terms of months, which is
Hmm.
because that's the number of payments we're going to make. And now we could arrive at a payment per month. So let's type in payment, and let's use our payment formula to calculate this. Yeah. So we want that per month. So remember this formula, what we have to do. There are 360 payments, but it's on a per month basis. So you
Right. So you
can't
have
use
to
the,
do this over 12.
yes.
Hmm.
Now, we also don't want to see it as a negative. So let's reverse it to a positive because it's not coming out of our pocket to pay it. The tenants are going to be paying this, right?
Hmm.
Okay, so we set this up already.
Yeah.
Now, now let's go over to the right side. We're going to start something new and in the G column. We want to calculate the revenues. So let's type revenues, yeah. Okay, now there are going to be a number of apartments, so just type APTS for apartments, right? And let's just say there are 3 apartments. So 1, 2, and 3, put that below each apartment. 1, 2, and 3. 1, 2, and 3, okay. Now to the right of apartments, there will be a monthly rent, so put monthly. Uh, then I'm going to give you the monthly rent for the one property that we have. Let me
Yeah.
do that for a second. Okay, let's get it from here. This is going to be modeled on a building that we have called 313 Hancock,
Hmm.
right? The first apartment is paying $4,500. Unit two is paying 2,300, and unit three is paying 2,400. Okay, so we also need the annual. So go over to the right side of monthly and type in, yep, annual, and just multiply everything by 12.
Yeah.
Now we want totals at the and at the bottom of all those. So on the yeah, so you can type in total and sum them up. Okay, so that's what we have as our scenario.
Hmm.
All right, now let's go to the right side in the K column.
Okay.
Right, we want expenses here. Okay, now for some terminology. There is something in real estate, they call it PITI, P-I-T-I. Have you ever heard of it?
I've heard it, but I'm not really 100% sure what it means now.
Okay, and it's not P-I-T-Y, but P-I-T-I.
Okay.
And it's important, that's why you should look it up first. So let's go to a website and just type in what is PITI in real estate.
Uh-huh. Moment. Principal, interest, tax, and insurance.
Exactly. It's important, and every single company, especially the mortgage companies, are going to be using this because this is going to be part of your qualifications on the loan. The pity is important. If you have a low pity, it really is a pity, you
Hmm.
know. So actually, a low pity is good. A high pity is bad
Yeah.
because you want to have less taxes and less insurance,
Hmm.
you know. But but those are the things that are taken into account when they're going to arrive at whether or not you're going to qualify for the loan. So that's why a lot of times we do learn this thing called pity. Now, let's go back to the spreadsheet.
Okay.
Now, and we're not going to, as part of the expense, we're not going to say PITI because the PI, do you remember what the PI was for?
Principal and interest.
Okay. And do you know where we get the principal and interest? It's an
It-
expense, but where
It's
do we
from
get it from?
it's from the mortgage.
It's from the mortgage because you are paying both principal and interest. And that's why when we do that schedule that we did before for the mortgage, we calculated the principal times the interest, right? And then you subtract the payment. And but that's telling you the PITI,
Hmm.
right? And that's calculated somewhere else. It's not here, right? But what is needed here is the taxes. So let's put taxes first.
Let me get rid of this.
Yes, get rid of that and type in taxes. Okay. So now we're going to pretend you're buying this property,
Hmm.
right? And we need to know the, so in this case, we're going to reverse things a little bit. So that's taxes, but what I want you to do is drop that taxes down one, bring it down one, yeah. And and above that one, just to the right of this, actually, in the L comment, just type monthly because we want the monthly taxes or we want the yearly taxes. Now, let's open up a website. We're going to look for the taxes for 313 Hancock Street. Brooklyn. Let's see if it gives it to you here.
It should be somewhere on here. Closing cost. Price. Here, tax history. See the tax assessments here.
Yeah. And it's 2570. So, what did Zillow say this property was worth? Could you go up again?
2 million.
So 2 million. 2 million. And it's saying it's worth 2 million, which is we did an appraisal, so we know it's a little bit above that. And then it will probably sell for two and a half, well, 2.3 million is probably what it will sell for.
Yeah.
But in either case, the annual taxes. So what did we say the annual taxes was?
I don't know if this is the annual. Is that a monthly
It
payment?
seems it seems low, right? It's for
Yeah.
annual.
Mm-hmm.
This is exactly why we bought the property because the annual tax is so ridiculously low. It's like telling us, get this damn property.
Uh-huh.
Right? So that's our annual taxes for a $2 million property. Crazy, right?
That's strange, yeah.
But when you see anomalies like this, you need to take it into account. Well, you don't see that in many places where you have $2 million properties that are paying that much in taxes, that little in taxes, I should say. It's in fact crazy because a lot of our buildings were paying $20,000 in taxes, not $2,500 in taxes.
Yeah.
See, so let's go back to the spreadsheet. The taxes, so it's annual, and it's 2,750. But let's just put it at 3,000, just to give us a little bit of an overestimate, right? And then we want to calculate the monthly afterwards. About $250 of it is monthly. Then we want the insurance, and I'm going to give you the insurance amount. So that's the TI, right? So PI is the $4,433, and the TI is the taxes and insurance, right? So that's where you get the PITI, the pity, and it's important. Now,
Yeah.
we're not going to put the monthly first because we're going to divide that by 12. The annual insurance is about $4,500. What other expenses do you think buildings have?
Property tax, insurance. The utilities.
Well, okay, so there are two utilities in New York. One is going to be electric. Let's type electric. Now, the electric bill for the house is not the electric bill for the apartment because each apartment will have its own electric that the tenants pay. So
Yeah.
this electric is the electric for the common areas, right?
Mhm.
No, and it's not much. So annually, it's about $1,200.
Okay.
And you could copy down. You could do a Control C on the 375 above, or copy it down that way. Yeah. Okay. That's one thing. What else do we pay?
Water.
Water. Okay. So they combine this to be water and sewage, and we normally put as W slash S, or you could do whichever way that you want to remember it by. Okay, this is usually a bigger bill than the electric, but it's not that much bigger, and this is around $1,500 per year. Okay. What else do you think we pay?
Mm, I assume there's maintenance, but I don't know if that's like a an expense that you can really estimate.
No, we have to because when we're buying a building, we have to kind of figure out how much is it really going to cost us for these types of maintenance issues. The older the building, the more it costs, right? But when we
Yeah.
bought the building and we renovated the whole thing, so we don't have much of a cost for the maintenance, right? But you could put maintenance here. Roughly, I would say it's about 3,000 a year. It is an older building, but it's not that old. So $250 per month, is probably good enough for the maintenance. What else do you think?
Vacancies?
No, okay, so I'm going to explain vacancy in a show up, but that normally is correct.
Uh,
However, we're going to hold off on that. Okay, so you
okay.
have taxes, insurance, electric, water, and sewage maintenance. Uh, Now, in New York City, because it's a cold place, we normally have heating costs. So let's type in heating.
Heating.
Okay, it's usually very, very expensive. But because I separated out the heating, right, it's zero. So you could put zero here. Okay? But we want to have it, as an expense that might be there for other buildings because this serves as a template, right?
Hmm.
Okay. After heating, the next cost is really something like management. Now we are self-managing, so you could put zero. There is a management cost, but what we do is we take something called distribution, and it's not really an expense. It's money for the guy who decides to manage. So if you manage, it's an expense to everyone but yourself, you see, because you're getting money, but your partners are not,
Yeah.
you know. So so that's why we're keeping the management at zero at the moment. And these are your general costs. Let's total these up.
Do you want to add the mortgage as well or no?
We'll talk. Oh, there's two things we're going to talk about. One is vacancy. The other one is what we call the debt expense. So let's
Hmm.
just total this up as total expenses. $1,100 a month is basically how much is going to cost you to run the building. $13,000 per year. Okay, now there are two expenses that are left out. Let's talk about vacancy first. Just type it in. We're going to delete it, but just so that we know we're talking about it. So tell me, what have you heard about vacancy as an expense? Do you know why
Whenever,
they keep that?
yeah, whenever your property doesn't have a tenant paying their rent, then you have no income. So any of the expenses end up coming straight from you.
Okay. Now, let me ask, what do you think the vacancy is dependent on?
If there's a tenant in the units or not.
Well, let's just say you're going to re-rent your apartment,
Yeah.
right, or your house.
Mhm.
When will you get a vacancy and when will you not get a vacancy?
Um,
Something to think about.
I don't know.
Let me
Whenever,
give, let,
yeah, go ahead.
well, I'm going to give you a question for you to
Okay.
think about first, right? So your house there uh, in the
Pembroke
Miami-Dade area,
Pines. Yeah.
right? Pembroke Pines, right?
Mhm.
Let's just say you advertised it for $10,000 a month.
Yeah.
What's the problem here?
That's way too much for that property. No one's gonna pay ten
And
thousand a
what
month.
and what would you expect to happen with the vacancy?
Be a while. I mean, probably
A
forever.
long
No one's
time.
gonna pay that amount. Yeah.
Suppose if you lowered it to 1,000 a month.
Someone will probably take that immediately.
Okay, in other words, you will cover the vacancy immediately.
Hmm.
So, given those two questions, when do we have a vacancy expense?
Um, when there's not a tenant
When there's not a tenant and
and the rent is not at an appropriate level.
yes, and it depends on the asking rent. If you
Hmm.
ask too low, you have a lower vacancy expense. If you ask too much, you have a higher vacancy expense.
Hmm.
You get it? Because it'll take you longer to re-rent the apartment.
Yeah.
But if you ask too low, it's rented almost immediately. You might get zero vacancy expenses.
Hmm.
So the vacancy expense depends on the rents. You see those rents over there that we put in for the monthly?
Yeah.
So there are multiple things that are going on here. First thing is you have to know what is the vacancy uh, as a percentage of all properties in the area that you're trying to rent in, right? So in other words, in the Pembroke Pines, right, for houses that are listed for rent, right?
Hmm.
How many are there? Maybe there's 10 houses, maybe there's one house, maybe there's 50 houses, right?
Yeah.
But the more houses that are listed, the less chance you're going to be able to rent it right away. You see the issue,
Hmm.
right? And we call that the vacancy rate, right? The higher amount of listings, the higher the vacancy rate, right?
Yeah.
The lower and this is in comparison to the overall uh, amount of housing. So if you have, say, 50 houses listed out of, say, 1,000, no, that's roughly a 5% vacancy rate. You see what I mean?
Yeah.
Do you know what New York City's vacancy rate is?
No, I'm assuming it's very low though.
Very low. It's 1% or less,
Hmm.
right? Which means that if I am priced right, I will not suffer a vacancy loss because I can immediately rent the apartment out the next when that tenant leaves. And this is exactly what happens. We have almost 30 apartments and
Hmm.
we hardly ever lose a month because as soon as we advertise our apartment before the tenant leaves, we already have secured a tenant the following day that tenant leaves.
Yeah.
That's how strong the rental market is in New York City.
Hmm.
And good qualifying tenants, tenants that have close to 1 million in income with credit scores in the 800s. We've done this so many times that I can tell you that is truth. That's why in this case, for a Brooklyn property like this, with those rents, we're not going to put a vacancy because we never get a vacancy expense.
Yeah.
Make
Yeah.
sense so far?
That makes sense.
Okay. But that doesn't mean it will happen to you. It depends on what you buy. So we do want to put vacancy in there, just like we have heating and management,
Hmm.
right? But we're going to put zero because but only in the understanding that this is a New York City property where the rents are reasonable. you will just not suffer a vacancy expense.
Yep.
Yep. Okay. Now, the next thing is the payment.
Mm-hmm. Payments.
No, we don't put it here.
No.
Now we have to talk about business and why they don't put payments as an expense. Why is payment not an expense?
It's paid by the tenant.
No, because in fact, all debt services like this is not an expense.
Mm-hmm.
That's a debt service, and it's not an expense. Why do you think it's not an expense?
Um, Not sure.
Okay, so we're going to relabel the top of this chart. Let's get rid of payment for a moment. So these are what we call operating expenses, right? Now, the question is, what is the difference between a operating expense and a non-operating expense? What does that sound like to you?
Um, Operating. I'm not sure.
Okay, let me explain it this way.
Hmm.
Suppose if you have a friend, let's just call him Bob.
Okay.
Bob's freaking wealthy. Bob is related to Bill Gates, has tons of money, right? Bob is going to buy this $900,000 property in Brooklyn, right?
Okay.
Now, while I had to buy it with a mortgage, Bob doesn't need a mortgage, right?
Yeah.
So keep that in mind. Now, let's talk about the taxes. I'm paying $3,000 annually for taxes. If Bob buys this property, how much would Bob pay in annual taxes? Bob will pay the same 3,000. Bob will also pay the same 4,500 insurance, the same 1,200 electrical, and so on and so on. Bob pays all of these same things because they're the operating expenses. In other words, these expenses don't change with the person buying the building. If
Hmm.
Bob buys it, he gets the same expenses as if I bought it. That's why we call it operating expenses, because it's the expenses to operate the building, no matter who owns it, right?
I see.
Makes sense so far?
Hmm.
Now let's talk about the mortgage. Bob's filthy rich,
Yeah.
right? If Bob's filthy rich, he doesn't need a mortgage.
Hmm.
If he buys it all cash, what is his payment?
Zero.
Right. But my payment is 44.33. It's different for me and Bob. You see the problem we have.
Hmm.
How is the payment an expense for me, but not an expense for Bob? That's why we separate the two out, because the payment to the mortgage, what we call the debt service, is not an operating expense. Because if it was an operating expense, it would be the same for Bob or me.
Yeah.
So the payment, what we call the debt service, is a non-operating expense.
Hmm.
So we cannot really put it here. This is only for operating expenses because Bob is not going to have a mortgage, therefore have zero payments. So it's not an expense for him, but it is an expense for me. And that's non-operating. We never include it in this chart of expenses, what we call operating expenses. But we take care of it later on.
Yeah.
Okay?
Okay.
Make sense so far?
That makes sense. Hmm.
Okay, let's go down a few. Now, we would like to do something called, let's calculate the cash flow,
Hmm.
right? So there's a couple of things. Actually, before we calculate the cash flow,
Yeah.
yeah, you can delete that and roll it out. Oh, no, we want to keep the vacancy. So do Control Z. That'll put it back, and you can knock that out. Okay, and go down a couple more. Okay, what we're going to do is calculate something called the cap rate.
Yeah.
So let's type out here cap rate. Did you learn this yet?
I remember I actually went over this with you at some point before, but
Oh, okay.
it'd be good to refresh on it, I think.
Okay. Well, this is what we call the capitalization rate,
Hmm.
right? And it's dependent on what other people are making for a building as if they bought it all cash, right? And it's usually a percentage, right?
Hmm.
And even before this, let's get rid of that for a moment and type in NOI, net operating income. But we are going to calculate the net operating income. Okay.
Okay.
The net operating income is only about the operating expenses and the revenues, right? It does not include the debt service because the net operating income, right? And notice the word operating, right, is exactly like the operating expenses. It's the same for Bob or me. It doesn't matter,
Yeah.
right? So if that's the case, then I want to know what is the monthly operating income that I will make, right? If I rented the property out for exactly what what Bob or I would get. Well, the building on a monthly basis makes in total rents on a monthly basis is 9,200, right? And the operating expenses for the month is 1,100. So how much do we make? So we're going to say equals, right? And we're going to take the total for the monthly, which is 9,200 on the top left. Yeah, that's it. And then we're going to minus off the monthly expenses. Okay, 8,100 is what it makes for me or Bob. It doesn't matter, right? It's the same thing for the annual. We're going to take the 110,000 and subtract that from the annual. Okay,
Okay.
so to Bob or me, these are our numbers, right? Now, below that, go to below that and to the left. One more, and go one more up. Okay, we want to now calculate our cash flow. So let's type cash flow. Okay, now we know what it's like for Bob or me, right? We will get $8,100 a month. But there's a difference between Bob or me,
Hmm.
right? Bob gets the full 8,100 a month because he doesn't have a mortgage. But that's not the same for me. So if you think about it, Bob's cash flow is $8,100 a month.
Yeah.
But my cash flow is the 8,100 per month minus by the debt service. Yeah. So I still make a substantial amount,
Hmm.
but it isn't what Bob thinks. You see what I mean?
Hmm.
So you have to always remember cash flow is the net operating income minus by any debt service.
Okay.
That makes sense now?
That makes sense. Yeah.
Okay. Now, um, I want you to go above the cash flow,
Hmm.
right? And then here we want to put the cap rate. So the cap rate again operates for the same for me or Bob, right? And that is equal to, well, what is the amount of money will someone make without a mortgage, right? Compared to what they're purchasing the property for,
Hmm.
right? So go to the right. And so we need the annual, um, the annual revenues, I mean, the annual NOI, right? Divided by, right, the amount that's purchased. And then we want that as a percentage.
Yeah.
Okay, so that's a cap rate, and it's saying that this is a 10% annualized cap rate, which means that it will give you 10% back in cash flow. No,
Hmm.
if you don't have a mortgage,
Yeah.
right? So that's what we purchased, but this was a long time ago. Now,
Hmm.
do we know how much property is worth now?
2
Reasonable
million
guess.
or 2.3,
Let's
I think
just,
you said.
yeah, but let's put it at 2 million and see what happens to our cap rate. So you see how the cap rate fell to 4.86%, right?
Hmm.
The question is, who uses the cap rate? Well, the cap rate is generally used by all investors, right? And it actually is the primary number that they look at because that number takes into account everything you've seen here, except for one thing, which is the debt that you have,
Yeah.
right? And you could imagine it this way: if you had $10,000 and you made an investment and it returned 4.86%, that's great.
Hmm.
It's not bad, it's not good, so let's just say it's average. Now, if you borrowed the $10,000, so say 9,000, you had 1,000, you borrowed 9,000, right? It
Yeah.
doesn't matter if you borrowed the money. The cap rate is still 4.8%, 4.86%.
Hmm.
So it doesn't matter if you borrowed money, but what changes is your cash flow because you have to pay the debt on the 9,000 that you borrowed.
Yeah.
You see. So now the other thing is, if you were going to take your 1,000 to invest it into another investment vehicle, you might want to invest in a 10%, investment vehicle. But the problem with the 10% is it could get you more it could get you more problems where that it's too risky,
Hmm.
right? So that's where the cap rate comes in. You know, generally, if you're paying for a low cap rate like this, 4.86% at the $2 million level, and you're getting a negative cash flow like this, you see how the cash flow changed to negative
Yeah.
and substantially negative,
Hmm.
right? Uh, you are not going to really do very well in this scenario unless you're willing to carry the property with almost a $2,000 monthly deficit. So two things could be the problem with this property. The problem is that the monthly rents are too low, which is really the problem here. The monthly rents are too low for for us when we sell it at 2 million. We wouldn't keep the rents that way when we go to sell. We would increase the rents dramatically,
Hmm.
right? And just to break even, we'd have to increase the rents dramatically so that we increase it above the $1,700 of cash flow
Yeah.
that is negative right now. You see what I mean?
Hmm.
I will tell you, New York City properties are very low in the cap rate. Now, what does that mean? People are willing to pay for a New York City property, right, where the cap rate is 4% or even slightly below.
Yeah.
So now you would have to adjust something given these rents where that cap rate will make sense. At 4.86%, I know I can easily sell this property, even though the person buying it will suffer a negative $1,700 per month cash flow. Now, why are people willing to take a negative cash flow like this?
Um, I mean, they're still paying a lot. 1,700 a month is still a lot less than 9,800 a month if they're trying to buy the property.
That is true, but they're not going to live in the property.
Hmm.
You see, so that this is money coming out of your pocket. Why would they do that?
Um, I mean, they're still paying off the mortgage. I mean, they're still paying towards it, but they're paying a lot less than they would. Um,
Still, someone now this is money coming out of the buyer's pocket because they're not able to get the rents in order to cover the mortgage,
yeah.
and pay the expenses. In fact, it's so bad that it's $1,700 in the hole every month. But people are willing to do that. Why?
Okay.
So every 10 years, a New York City property doubles.
Uh-huh.
If that's the case, and you were paying, let's say, let's say it was always a $1,700 negative cash flow for the next 10 years. How much money would you have paid in negative cash flow? So that's a
210,000.
well, it's 120 times 1,700. How much is that?
Well, it'd be just 10 times the annual, right? So
Oh, that's true.
210,000.
That's true.
Yeah.
Okay. But your property doubled from 2 million to 4 million.
Hmm.
Who cares about the negative cash flow if you're making $2 million in profits?
Yeah,
Do you see what I mean?
that makes sense. Hmm.
That's why they do it. That's why they're willing to have such a low cap rate because they're betting on what we call appreciation.
Hmm.
Now, I will tell you, that's what we did, right? We start out at negative cash flows and we wind up with a lot of positive cash flows over the decades,
Yeah.
you know. So our scenario is much different because when we bought the property, we paid 900,000. So change that to 900,000. This was in 2015.
Hmm.
We locked in the price. Now, I also want you just to do a little change on the mortgage. The mortgage we locked in is 3.5% at that time. So this is generally our scenario. We are making so much money after holding the property for maybe 13 years, right? But that's the way New York City properties are like, that we're able to keep the rents low for our tenants and still make a huge amount of money on the cash flow after 10 years and also on the appreciation where it more than doubled the 900,000.
Yeah.
See, but a lot of people call it gambling. And I'm like, no, that's not gambling because this has been going on for 50, 60, 70 years in New York City. This is just the dynamics of New York City, but you have to pay high for it.
Yeah.
Now you could use Control Z and just come out of it. Keep on doing that until, okay. And one more time because we want to get back to the $2 million price. There you go. Okay. Now, I will tell you 4.86 is not, that's still too good for a buyer. So change the 2 million to 2,150,000, which is the appraisal price. Okay, even this is still a reasonable price for someone to pay because the cap rate at 4.5% is actually reasonable.
Yeah.
The thing is that mostly cash buyers will buy this, people with a lot of money. And there are a lot of people in New York City with a lot of money to purchase this.
Hmm.
You see what I mean?
Yeah.
All right. Now, so we're going to stop here as far as the um as far as our cash flow statement,
Okay.
right? And then the next lesson is going to be the 10-year projection of
Okay.
all of these costs going forwards for 10 more years.
Okay.
And that's when you start to realize, right,
Hmm.
that you know what? This crazy price for this property may actually be worth it,
Yeah.
even at a $2,500 per month loss in cash flow.
Hmm.
But you won't know that until you do a 10-year projection of everything.
Yeah.
So, but we're going to have to make some assumptions, and those assumptions are going to then be based on economics. And the economics is going to be specific of the cities that you're buying in. You see what I mean?
That makes sense. Yeah.
So, and that's where we go to different cities, right? You got Miami versus New York versus LA, San Francisco, all of these, they all have different economics and they will all have different projections,
Hmm.
you know. So, but you do the spreadsheets the same, but then you make different assumptions for those,
Yeah.
right? And and the biggest assumption you're going to make is on appreciation rates.
Hmm.
Yeah. And then, because each city will have its own different appreciation rates based upon its history.
Yeah.
Now, we don't normally buy a property like this where it's so far negative, right? If we were going to do it today, we wouldn't put 20% down and suffer a $2,500 per month loss on that.
Hmm.
We would put, let's put 30% down. Let's take a look and see what that does.
I'm assuming also if you bought it at this price, though, you'd want the rents to be higher.
Yeah, we would increase the rents. So we would have to do this plus increase the rents roughly $300 to $400 each, which it should be able to do, right? And then you break even, but you can't put 20% down and have a zero cash flow,
Yeah.
no loss. So that will be the issue. Now, the other thing to consider is that the mortgage in this scenario here would be 1.5 million,
Hmm.
right? So if you think of it, if you do a very simple calculation, right, the 1.5 million over 30 years, what is that annually? So if you take the 1.5 million and divide it by 30,
50.
no, they can't be. Oh yeah, 50,000, right.
Hmm.
50,000 times 30, yeah, that's right. So just let's say everything just stayed the same. You're still making $50,000 per year in just the mortgage going away.
Yeah.
Now, if you do this 10 times, you're making $500,000 a year.
Hmm.
So if you broke even with the cash flow and you had 10 of these properties, you're making $500,000 a year.
Yeah.
That's why we bought so many properties because of no, it wasn't really for the cash flow. It was because the mortgages are all disappearing in 30 years, and we know what the annual equity that we're building up per year. It's substantial.
Yeah.
And we knew at some point in time it will go so high that we could only win,
Hmm.
you know. So, and we are. We're gonna, and not only are we gonna win, we're gonna win without mortgages because the mortgages disappear. We won't even need the mortgage. What'll happen is now our cash flows as those mortgages disappear are just going to skyrocket. Because then we won't have that payment anymore. That $10,000 payment, that disappears,
Yeah.
So that's really how we did it,
Hmm.
you know. That was our end game, to get enough properties that, over time, it will only win.
Makes sense.
you know, and win substantially.
Hmm.
You know, it's not very difficult for people to do these calculations. These are not. I would say by the time you get to 12th year in high school, 12th grade, and then you go to
Hmm.
college, you have more than enough knowledge to do these calculations.
Yeah.
Yet people don't do it, you know. I'm not quite so sure why they don't,
Hmm.
because if you do these calculations and you do the projection, you have everything you need in order to go ahead and be successful in a business, whether or not it's a rental business or any other business,
Hmm.
but they just don't do it, you know. So we're going to stop here. You could end the recording.
Yeah.